A lot of us like to think that we're pretty good at making financial decisions. However, so many factors go into that decision making process that we may not even be aware of. A lot of research has been done on how we make these financial decisions, and there's a lot that we can think about that goes into our decision making process and the decisions in those around us when it comes to the financial realm. Our personality plays a huge role in how we make financial decisions. Plieger and his team at the University of Bonn in Germany did an experiment in which participants would be winning or losing money in a simulated stock market. Prior to the simulation, participants were given a questionnaire that asked them for their gender and a variety of questions meant to gauge their personality and what type of person they were. They also asked for things like stress that would be used as a control, and those control questions were asked multiple times throughout the study. The results indicated that men made riskier decisions with their stock portfolio. Meanwhile, women tended to diversify their portfolio and minimize risks. The participants' self-directedness, which was described as being self-confident and having an internal locus of control, also played a huge role in how they played the market. The confidence that they had predicted a greater risk-taking behavior. Surprisingly, the study did not find that impulsivity or novelty seeking to be a huge influence, despite what most would assume. Gender and that self-directedness were much bigger parts of how people were making their decisions in this study. So you may think just because you're not an impulsive person or because you're confident that you're good when it comes to financial decision making and not making those risky decisions. But that confidence might actually make you more likely to make these risky decisions. You may be quick to think that because you've been financially successful in the past, that you're good at finances. Or you may think that past failures were out of your control, but that you really were making the right decisions and are a good decision maker. But both of these ideas might actually be false. A team at Maastricht University in the Netherlands, led by Hoffmann, did a study in which investors were recruited as participants and were asked questions relating to how economically and financially literate they were and how much they believed their success and failures were due to skills. They were asked these questions repeatedly over the course of 3 months. In these 3 months, they also gave the researchers key banking information that they could analyze to see how their portfolios were doing. Participants who were more confident about their skills and abilities were more likely to make risky investments. Then they're thinking about whether they earned that outcome was impacted by the outcome itself. If the outcome was negative, participants were likely to blame outside forces and assume that they couldn't have known any better. However, if the outcome were positive, then the participants were likely to believe that their success was due to their own abilities. This research suggests that individuals may struggle to learn from their mistakes because they're misattributing what went wrong in their previous financial decisions. They may also become overconfident when they've met success, leading them to make more risky financial decisions due to believing that they are a more skilled investor due to their success. So, it is important that you not let yourself become overconfident because of your success, but that you also learn from your mistakes when you see failure. You have to learn to look at your past as unbiasedly as you can and try to figure out what worked well and what hasn't, and try to better yourself and treat every scenario as its own event, regardless of what's happened in the past. So, even if you are confident that you are a good decision maker, you have to remain cautious about your financial decisions. Another study done by a team at the University of Akron measured participants on how much they believed they were good financial decision makers and how much they believed they were financially literate. They were then given tests on their financial literacy. It was found that the majority of participants understood around how financially literate they were. However, many more overestimated their competence than underestimated it. And most of the participants had blind spots, or areas that they thought that they were literate and knew well about, but in reality they were not as competent in. This suggests that those who are competent in their financial abilities may be more at risk to make poor financial decisions, as they won't be seeking out help or putting proper thought into it because they are confident about those decisions. So this study shows that even if you believe yourself to be financially literate and are confident about the decisions you're making, that seeking help and putting proper thought into every major decision is necessary to avoid making major mistakes. All these studies together show that a lot goes into your financial decision making that you may be blind to. It's important that you not be overconfident and that you are not afraid to seek advice and do research on every financial decision you're going to make, even if you think you're going to do well.